Oh my goodness. Have you ever asked yourself, where is all of my money going? Like you see all of this money flowing, but no idea how the business is actually progressing. Well, that's why it is critical to understand a balance sheet versus an income statement, because these are two important financial statements business owners and accountants should be reviewing at least once per quarter. In fact, one of the most common reasons small businesses fail is due to poor financial management. Now, I need you to take in every bit of these statistics that I am about to show you. So, according to data from the U.S. Bureau of Labor Statistics, roughly 20% of small businesses fail within the first year. 50% go out of business at the end of their fifth year. And 33% make it to 10 years or longer. That's 70% of business failure. But you achieve more business success and wealth by understanding a balance sheet versus an income statement. So I need you to click the like button and subscribe if you want to learn about these two critical financial statements for business. And as a special treat, I'll be going over the third critical financial statement. So stay tuned. Okay, let's jump right in. So first off, let's talk about what a balance sheet and an income statement is and the difference between the two. A balance sheet is a financial statement that presents a business asset, liabilities, and equity at a specific point in time, such as the time of reporting. To dumb this down, it shows you the value of your company at the time of reporting. It does not represent the longevity of a business, but is simply a snapshot of the health of your company for a short period of time. This is usually used to plan budgets and/or to predict revenue for the following year. Also, the balance sheet helps derive evaluation ratios such as debt to asset ratio, which basically shows you the percentage of assets financed with debt. In other words, it shows if your business has enough funding to meet its debt obligations. The lower the percentage, the better, because it shows that you have an excessive amount of assets to cover your debt. On the other hand, an income statement is a financial statement that shows revenues and expenses at a given time period, such as the quarter or year. Essentially, this statement shows whether you are making money, a profit, or losing money, a loss. This is why you may hear people use the term profit and loss statement interchangeably with the term income statement. In addition, an income statement helps derive ratios such as a profit margin. This ratio shows the profitability of your business after all of the expenses are subtracted out. Now that you know what a balance sheet and an income statement is and the difference between the two, wait, world stop. Hi, my name is Sierra Stanberry, a corporate accountant at a Fortune 500 company and the wife of Sean at Life Accounting, the accounting company that saves people from high taxes and low profits. Carry on. Okay, so let's hop into why these are the most critical for operating a business. The balance sheet is critical because if your liabilities outweigh your assets, your business has no present value. It means you owe more money than you have. Let's say you have $60,000 in assets, which consist of your cash, inventory, etc., and $70,000 in liabilities, which consist of money you owe to your suppliers or maybe even the bank. In this particular situation, you are owing more money than you actually have. Seeing this will help you make better decisions within your company, such as not getting any more debts or taking on more risks than what's needed. Come on, how can anyone visually know this if they don't have a balance sheet? You can't. Too much debt may harm your ability to make more cash. So make sure you are reviewing your budgets frequently to see if you can cut back elsewhere to avoid getting debt. Also, keep in mind, just because you have a negative balance sheet does not mean your business is doomed. For example, let's say you're a real estate investor. The down payment initially is considered an asset in the form of equity. But also, you have a liability to pay on that property, which will show negative equity on the balance sheet. However, the income you are receiving for that rental property is increasing your net income, which in turn gives you the profit to take care of that liability. All right, so why is an income statement critical for your business? It's simple. No one wants to lose money. As mentioned before, the income statement shows whether you are making a profit or a loss. Let's say you have a business. Your sales revenue is at an all-time high of $50K. You take out the amount of money you spent on your product, which is roughly $10K. This gives you a gross profit of $40K. You follow me? Good. Now, please do not mistake this as your number that coincides with the total profit of your business. It's called gross for a reason. If you would like to know more about gross profit, check out Crystal's video on gross profit versus net income, links below. Let's continue with this example. Okay, so you have a gross profit of $40K. Let's say your total expenses were $60K. This leaves your net income at negative $20K. Wow, Wasby, do you understand what's happening here? You have a gross profit of $40K and your expenses are $60K, which gives you a loss of $20K. You must exclude expenses from your gross profit in order to get the bottom line number, which is also known as your net income. This, my friend, is what you should pay attention to when looking at your income statement. Now, if you have a startup company, you just may see a negative net income because you are intentionally investing for the future. However, if this is an established business, then having a negative profit may not be good. All right, so how do you utilize the income statement in order to get your business profitable? It's actually pretty simple. Adjust your expenses. For example, you could adjust your rent expense. Maybe you need to run your business remotely to completely remove your rent expense. Overall, just remember to review your expenses to see where you can cut costs. So earlier I mentioned I would give you guys a special treat by going over the third most critical statement for small businesses. So here we go. The third most critical financial statement for small business is a statement of cash flow. So what is a statement of cash flow and why is it important? A cash flow is a financial statement that shows the cash position of the company, or in other words, how much cash is entering or leaving your company. A business must have enough cash to be successful. A business needs cash to pay its expenses, bank loans, taxes, etc. You get the point. And guess what? This financial statement tells you if you have enough cash to cover all of these things on a monthly basis. Have you ever heard of the saying, what you don't know won't hurt? Okay, well, let's not apply this to your business. Otherwise, your business may fail. Now, I want to hear from you. Do you actually review a balance sheet or an income statement for your business? Tell us in the comment section below. Coming up next, we have 2 more videos that will help you master business finances and build your wealth. Thanks for watching, and we'll see you over there.